Hello and welcome to Options Guide TV. Happy 4th of July. We're going to set off some fireworks today because we're going to do something kind of fun. We're going to have a 0 DTE Butterfly Smackdown. We're going to look at different one-day butterflies, and we're just going to say if you're thinking about doing one in the SPX, what are our options? What should we do? Should we do a standard butterfly? Should we look at an open wing butterfly? Should we look at a skip strike, otherwise known as a broken wing butterfly? And last but not least, we'll look at it on the call side of things, and we'll look on the put side of things. Now, we're taping this show on a Wednesday. The market is almost closed, and we're going to use one-day options that expire at the end of the day on Thursday. So the prices might be a little bit different if you set it up the day of, but the concept is what we really want to dig deep down into and try to come up with. So we're going to start by running to my book, the Options Playbook, and let's just introduce the strategies. Now, unfortunately, the open wing butterfly I don't have inside the website just yet. Might be coming soon, hint, hint. But with that said, here's a standard butterfly. We're looking at just a butterfly with calls. We're going to be in the SPX when we run over to the Tradier Pro software and use live markets. But the situation here on 0 DTE butterflies, I usually like to center them right around where the underlying stock is trading. So if the stock in this instance is going to be an index in the S&P 500 index, is trading close to strike B, this is going to be the strike that we're selling. We're then going to buy the wings. In our situation, we're going to go 20 points wide, but it's really about the type of risk that you want to address. Obviously, if you go wider, you have more upside potential, which usually means you have more risk up front. It's going to cost you a little bit more to do. We're going to keep things simple. We're going to keep everything about a 20-point wide butterfly, and we're going to set them all up. And hopefully the market doesn't move too much because I have them all set up at the money right now. And we're just going to say, here's the trade-off of this one versus that one, and basically have a smackdown. And you can decide which butterfly might fit your risk profile and your preferences. And then we'll talk a little bit about the timing of the butterflies. So the next butterfly that we're going to look at is a skip strike, otherwise known as a broken wing. It's more commonly known as that. But if you watch Options Guide TV more than once when we've introduced skip strike butterflies, I'd rather talk about it as a skip strike. I'm not going to get into the definition and the reason why. But in this instance, we are skipping a strike. We're doing this on the call side of things, and that we would like, this one's with the puts. So we're going to do one with the puts, and we're going to do one with the calls. So the stock is still going to be in the center. It's going to be wherever you sell these option contracts. So we're going to be at strike C. The index will be somewhere close to this. We are going to sell two of those. We're going to buy a wing up above, and we're going to buy, we're going to skip this wing. That would make it a standard butterfly. And then we're going to buy this strike A down below. If we can get it done for a net credit, that is beautiful. It's kind of hard to do in our 20-point wide situation that we are going to do. But if you do that and the market goes up and you're using puts, you can actually be profitable from the market not staying where it's supposed to. But you're adding additional risk here. Basically, the difference between strike B and strike A is an embedded credit spread. And so whatever that credit spread requirement would be is what your requirement is going to be on that trade. And if you want to read more about that, you can go and open up these little boxes on the side. But Options Playbook, just type in skip strike in the search box, and you'll get the offerings for the call for the puts. And then we're going to flip the script. This whole thing's just going to flip. And now we're going to look at it with calls. Okay, so in this instance, everything's centered around strike B. We're skipping strike C and buying strike D. But once again, at the money would be strike B. Hopefully get it done for a net credit to the account. And if we do that, then if the market goes down, we'd be profitable on the trade. Now, the last one is an open wing butterfly. And I don't have a profit and loss graph of it, but I'll show it to you once we get into the Tradier Pro software. But in this instance, we stopped short. Instead of buying strike C, we buy strike B and a half, I guess is the best way that I would say it. You're going to pay up a little bit more for the butterfly versus the standard, but it's going to open the swing. And that means that if the market continues on up, you can actually be profitable if the market just doesn't stay where it's at. So you have a wing that is open that allows you to be profitable if the market moves in that direction. All right, so let's pop out and we're going to run to the Tradier Pro software real quick like. And like I said, the markets are moving. We're taping on a Wednesday. Happy 4th of July. This is your bonus video, but I really like this video and I really like this setup that we're going to talk about today. So we're going to start by going to the what if calculator. And we're going to look at the long butterfly, the first strategy that I brought up. And now I'll just show you the strikes here. Today is the second. These are the third. It would be better if I would have done this right on the open and use those type of quotes, but they're going to be a little bit cheaper because of the fact that we are that we have more time premium in the option contracts, right? It's the close on Wednesday and we're doing a Thursday using Thursday options. Okay. But the concepts are real. They're all going to be relative to where, if you're thinking about doing a zero DTE and you're doing it on the open, the concepts will apply. Okay. So here in this instance, the at the money butterfly is trading for $3.25, which means that is your max risk on the trade. Below the zero line, we're going to be around $3.25. The max upside would be the max it could trade for is $20 minus the $3.20, or it's $15.80. We're going to put this right at 320. Okay. So that is our max upside. We're not looking to get the max upside. If you ever do a 1 day butterfly, remember the concept that pigs get slaughtered, right? So if you ever make the maximum on a 1 day butterfly, you should really get the stupid award for that because you should have got out earlier. It's a trade where you put it on for $3.20. Yeah, you maybe say, I'm only going to risk half of that. So if it's trading for 160 or so, I'm going to get out of the trade at that point in time. And then on the upside, if I can make 160, I'm going to get out of the trade. I'm going to do this as a 50-50 type trade. I might let it run a little bit more. Maybe I want to make $2. I want to be standardized in what my upside is versus what my downside is. And that's the way that I approach it. That's the general lesson about butterflies on zero DTE. I like to put them on in the morning and I like to take them off well before the close, if I can, 1 or 2 o'clock, hopefully. But the rate of time decay, the theta decay, is insane on these butterflies. If the market can just stay within the range for a couple of hours, you can sometimes make up to $1 on your trade. Okay, so that is an SPX butterfly. That is the standard butterfly. The market's at 6,220. Oh, wow. We're right at the strike. You can't get better than that. Now let's move to the next one. So this is the open wing butterfly. This is the position that I was talking about. In this instance here, we got to send it to ticket. That's what we got to do. I'm like, why is it trading for the same price? Here we go. So we increased our price quite a bit, actually. We're going over $2, and the market's moving, so it might be a little. Let's call it $2. All right, and we'll put it right at 540. And so if I do this trade and I pay $5.40 for it, it gives me an out. Now, ideally, we would pay less than $5. That would be the ideal scenario if we're just going to open up one wing. So in this instance, we're paying $5.40. This is the zero line. We pay a little bit more up front. This means we would be bullish on the trade. If the market goes down, we lose $5.40 as opposed to $5.20. Strikes are the same. We brought this one in, we opened up that wing, it increased our costs, but now if the market goes up, we basically break even on the trade. We have no risk to the upside on this trade. We're putting it all together. I kind of like this version of it, but in this instance, I'm only going 5 points wide. I might go 10 and bring in a little bit more risk, or I'm only going I'm only the open wing is only 5 points. In other words, we're buying the 6,200, selling 2 of the 6,220s, and then instead of buying the 6,240s, we're buying the 6,230s. Now 35s. Now I might do the 30. Right? Well, let's actually throw that in there real quickly. Let's see if we do the 30. How much does that cost? $760. Okay. I got to pay more then if I do the 30, but the maximum that it could trade for if the market goes up would be 10 points, which is the difference between the width of this strike and this strike. This is 20 points wide. This is 10 points wide. If we do the 35, that's 20 points wide and 15 points wide. The maximum it could trade for is $5, and I'm paying $5.20 for it. Okay. I'd like the open wing. You can flip the script and you can be bearish on it if you'd like. I like paying a little bit more up front, but then only having one side, one direction that can kill me on the butterfly. And ultimately, I just want time to decay. And if time decays, that's my ultimate goal of a 0 DTE butterfly, is to make as much as I can because the market stays where it's at for a couple of hours, the whole gamut, right? But the downside of 0 DTE butterflies, you have great theta, but if the market goes against you, you lose quickly too. So there's always a trade-off. You have high gamma, high theta option contracts, and the theta is good if the market stays, gamma is bad if the market moves, right? And I like them in the SPX because it's a cash settled index. So if you fall asleep and you got in the money option contracts with the SPY, you got to worry about exercise and assignment. In the SPX, you don't. Okay, next one. Long butterfly with calls, I hope. Let's make sure. Yep, this one's with calls. So I'm going to send this to the ticket. And once again, I kept the same type of concept here. Market's at 6110. Oh, I got to check the boxes. 1 second here. And let's see where this one's trading. Yeah, it's a net debit. Now, when I first set this one up, it was a small net credit. Now, in this instance, we're going to skip that strike. So we're doing the 6,200, 6,220, 6,240 would be the standard. We skip, we add a requirement in, and we greatly reduce the cost. Now, I'm going to skip one more. I'm going to do the same type of thing that I did in the open wing. You'll add a little bit more risk, but let's go to the 6,250. Get a cheaper option out of the money and see if we can get this done for a net credit. All right. So now we're talking 50-cent net credit. I'll take it right there. So we'll send this one to the what if calculator. Things will change on me. So it looks like the 1,000-point risk is really where we want to talk, where we want to be and where we want to talk about, because if you do the standard butterfly, your risk is 325. It's what you pay for it. You do the open wing. We only have risk in one direction of the market, but the cost is $525, and that was your max risk. Now, if you open the wing a little bit more and you stop a little shorter, to have $760 worth of risk in that scenario. And then when that happens with that risk, you end up having profitability if the market moves in one direction strong. And in our instance, it would have been on the call side of things. All right. So now we have this trade on, And we're adding a little bit more risk from 620 to 640 is a standard, 6220 to 6240 is the standard butterfly. We're going to go to the 6250. That means we're embedding a 10-point credit spread into this to pay for the butterfly. If the market goes down, we make 50 cents. Our max risk is 10 points minus the net credit received, or $9.50. Market is behaving. It's hanging right about where we put this trade, well, where we started on this trade. It's right at 6,221. So there's a little bit of fudge in these numbers because the market's moving while we're doing it. But this is another alternative that you can put on. It's going to have a little bit more risk, but once again, it's only in one direction. And in this instance, it would be on the call side if the market continued on up and made more than a 1 standard deviation move, by the way, to the upside over the short time period that we're talking about. And then that would add a little bit, and that's where your risk would come in. Now, if we look at the next butterfly, and this one's only going to be 5 points wide too, so let's look at this one. 62, 62.20. I can get this one done now for a net credit of 50 cents. Okay, so, oh, no. Send to ticket. Here we go. 62, 64, 61.90. So this is showing a 75-cent net debit. And so our risk now is on the put side of things. We're bringing in a small net debit. Here we have 20 points. And then to the downside, we have, it would be 6,000 exactly. And we skip it and we go to 61.90, which is 10 points wide. And we're still paying a small net debit, which means that if the market goes against us, we have to pay that debit. Okay. So how can we make it a credit? We're going to have to, it'll be painful. And I don't know if it will be worth it. But if we go down one more strike to the 85, and now we're at a 30-cent net credit. But we've increased our risk by another $500. So in this instance, we'll send this one to the what if calculator. Like right now, it's showing our risk right at about 1,000, right, on the trade. Let's send this one to the what if calculator. And now we're getting closer to the 1,500. Let's move down. Let's zoom in. But honestly, if you're doing an open wing butterfly, you want to get it done for a net credit. So, I'm sorry, if you're doing a skip strike butterfly. Now, out of both of these, out of all three of these trades, it's all about your risk and what you're willing to take on, right? So you can do an at the money butterfly for $325. If you have $1,000 total of risk, you could do 3 of those butterflies. Now, the risk of the at the money butterfly, the standard butterfly, is you lose in either direction. The market goes up too much, if it goes down too much, you lose in either direction. If you do the open wing, and I'll go back to the open wing, and my vote is, I think in the Smackdown, the open wing is leading. And let's make this one profitable on the way up. So we're going to change this. Let's send that to the ticket. And we're going to make this, instead of a $5.40 trade, let's go to $62.40. Now it should be a $7 trade. No, I went the wrong way. 62.40, 62.50. Send a ticket. We are, 62.30, 62.30. There we go. Now it should be a $7 trade. Okay, so I'm going to send this to the ticket, send this to the what if calculator, and these are the 3 that we're going to look at. So our total risk on the standard butterfly, 20 points wide, was $325. Our total risk on the open wing butterfly is $780. But what I like the most about this is we open that wing quite a bit. So if the market goes above 62.30 in this instance, we're going to make $230. Now I want your eyes to focus over here, but I'm right on this line, right at expiration. And based off of where that midpoint is moving, $237 if the market goes up. We also can make money if the market goes nowhere and it just stays here or drifts a little bit lower. But our total risk now is $780. We could buy one, right? If we're looking to risk $1,000, we could buy 3 of the butterflies if we wanted to do 3 of the butterflies, but the market's got to stay where it's at. And then we look at the skip strike, and our skip strikes that we have this one is the put. Yep, send a ticket. So in this instance, if we're wrong and the market moves against us, okay. Oh, I got to check the boxes. Sorry. I wish these boxes would just, I'm going to have to talk to Lex and get these boxes checked so I don't have to do this all the time. That should be the default. So let's send it to the ticket. And now if we are dead wrong, we have, we'd make around 40 cents. It was 35. I think it was closer to 50 when we put it on. And that would be our risk on this trade. But if the market stays where it's at, we will benefit precipitously from time decay. So this one has a better rate of time decay on the trade. But if the market goes up too much, we're okay. But no, we're not as great as we are in the open wing. And our total risk will be $1,000 minus the net credit received. And you see that here. Oh, on this one is 1,500 because we had to go down an extra 5 points because of the volatility skew in the SPX. And then we have one last one to look at. So here is the butterfly, and I got all the boxes checked. And this one's about a 50. I like the 50. It was 50. Let's keep it there. A 50-cent net credit to the account. Market is behaving. I'm really happy that the market's behaving for this little video we're doing. But 6,220. So it's hanging right where we're at. 50-cent net credit to the account. Your risk is now to the upside. 0 risk to the downside. You can make a small net credit of 50 cents if the market goes that direction. So what do you think of the Butterfly Smackdown? Please put the comments down below. Which butterfly do you like best? I know that it is very vogue to do 0 DTE butterflies in the SPX and in the SPY. I like the SPX better because of the cash settlement. But that is the big buzzword nowadays is short-term trades in 0 DTE option contracts that want high theta. And if you are correct on your butterfly and the market stays where your middle strike is at, butterflies love time decay because you've sold 2 at-the-money option contracts and you want all that time value to come out of them. That's it for this edition of Options Guy TV. Thank you so much for hanging out with me on the 4th of July. Now go enjoy some fireworks, and we'll be back on Monday. And who knows, maybe we'll do a 0 DTE butterfly in the SPX on Monday. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.